Hey guys, Albert, the real estate guy here. Let's walk through a 5-year case study together on a real estate investment that we're going to make. I guess just in terms of preamble, this is an example only. I don't guarantee, obviously, any outcomes, good or bad. There's some I've factored in capital gains, but there's some nuances of tax considerations and whatnot that I haven't considered in the model. I haven't considered things like renovations and whatnot. Just meant to be kind of an overall example, a realistic one, but it's something that kind of give you an idea about what goes into one of these investments. How do the numbers work out? Every situation really ultimately is different. You've got all my contact information. If you've got any questions, feel free to contact me for some specifics. Okay, let's drive into the case study details. So what are we working with here? We have, for example, we're purchasing now a single-family home as an investment in the Hamilton and Burlington area. Okay, so this is really a second property. Generally, for the numbers are a little bit different for a principal residence or a first property, but in this case, we're considering an investment. So we're going to lease this out to a family. After 5 years, we're going to sell the property, right? And then we're going to take a look at kind of how the numbers ultimately work out. And then finally, Albert, the real estate guy, he helps us through the whole process, so we know that we're buying for the best price and selling for the best price. I promise that's the last advertising and marketing you're going to get here until the end of the presentation. Okay, so now jumping into the actual purchase and the investment. So let's have a look. On the property and the mortgage, right? The house we're going to purchase here is $550,000. Okay. When you buy a second property or an investment property in Canada, you generally require a 20% down payment. That works out to a down payment amount of $110,000. I'll talk about this a little later. If it's your principal residence and whatnot, you've got options. If you're a first-time home buyer, you've got options to really put down less than that 20%. But in this case, the down payment is going to be $110,000. The leftover amount, then, the amount that the bank is lending us for the mortgage, is $440,000. Okay. Now, to close on the house, we have some closing costs. Right? Provincial land transfer tax. In Ontario, it's a calculation on a $550,000 property. It would be $74.75. I will say, if you're buying something in the city of Toronto, you've got to double that. There's a municipal tax the city of Toronto has put on property sales there, so you'd be into about $15,000 in land transfer if you're doing it in Toronto. In the Hamilton Burlington area, it'd be $74.75. We're going to factor in some lawyer and disbursement costs. That's given us a total closing cost of $9,775. Okay, so now if we take a look at this, then we need our $110,000 down payment. We need our $97.75 to close on the property. So our total investment into this property to buy it and close on it is $119,775. The bank has financed us for 80% of the property value, right? So the bank's given us financing on that on the $440,000. So now, as we drive into the carrying costs and the operating cash flow, let's have a look. Okay, our mortgage payment on that $440,000, based on a 2% mortgage rate over 25 years. Right now, you can get mortgages in at about 1.6 or 1.7. We're going to use 2 here for a round number. So our monthly mortgage payment is $1,863. For those of you that don't know, when you make a mortgage payment to the bank, a portion of that is being paid purely as interest, but a portion of that is going to pay the principal on the value down. So we're paying down that $440,000. We'll see kind of how that translates in 5 years, but I just wanted to kind of bring that to your attention. We'll need house insurance. Generally, $1,000 a year, kind of in this area, property of this type. So I've got $83 a month. In terms of property tax, again, a property of this type in the Hamilton region, Burlington region, you're looking in and about $3,600 a year. So in this case, you'd be into about $300 a month, which makes our total carrying costs $22.46. Okay. Now we're going to go ahead and lease the property. And for the case of for this case study, we're going to assume we're leasing this property for $22.50 a month, right? It would be in and about that. But generally speaking, let's just assume this is that nice round number. So now, when we take a look at our carrying costs and we take a look at what we're renting for, you can see here on a monthly basis, right? We're generally cash neutral, right? The rent is by and large covering the cost to carry the property. Another thing to remember here, guys, is generally the family that's renting the property from you, they're going to pay all of the utilities, right? So they're paying their own internet, their own TV, their own electric, their own gas. So really, what you've got to consider in terms of carrying costs are just things like property insurance, property tax. If you want to get into putting some contingencies in for having it vacant and whatnot, you could do that as well and create a more complex model. The other note that I'll say is this is cash neutral. Generally, on a single family property, you're going to be, if you can get the cash neutral or slightly cash positive, you're doing great. You're going to pick up most of your gains in a single family home in appreciation. Whereas if you're looking at a multi-residential, multi-unit thing, you're going to be focused more on my operational cash flow. I want to be making money monthly on a multi-unit. On a monthly unit purchase. On a single family, again, I'm looking at appreciation. So let's consider now, right? What's this going to look like? What's this property value going to be in 5 years? So if we're going to look forward 5 years, let's look back 5 years, right? What we've got here is actuals in the Hamilton Burlington area from 2011 to 2021, so kind of the previous 10 years. And you can see 10 years ago, we were in about 300,000. Today we're up north of 700,000 for an average residential property in the area. You can see here, to get into a little bit more detail, these are kind of the growth rates year to year, right? These are the price increases, 19.7, 9.8, on and on. So for the previous 5 years, we had an annual average growth rate of 12.9% in this area. So if we bought a property in 2016 for $550, in 2020 it was worth about $818. Okay. Now, that doesn't mean that's what we want to project for the next 5 years. It's really just a data point. And for me, I'm a little bit more conservative, even though the market's been really fantastic in Canada in general, this region specifically for the past 25 years. We're going to be a little bit more conservative. So we're going to consider for 2021 through 2025 a little bit more of a conservative rate. I'm considering a 7.6% growth rate for annually over those 5 years. For example, here in 2021, I'm anticipating 7%. The Ontario Real Estate Association believes it's going to be higher. I actually believe it might be higher as well, but let's go ahead and stay conservative. That tells us that this purchase we made in 2021 for $550, in 5 years it'll be worth in or about $740,000. So let's now consider 5 years from now, where we're going to sell the property. How does this all roll out? So we've got the original mortgage amount, right? This is the $440,000 that the bank originally lent us. Over the course of that 5 years, we've been making mortgage payments regularly. Okay, so the amount of principal paid down over that 5 years is $71,411. That means we still owe the bank for that property $368,589. Now, when we go to sell the house, okay, let's assume the value of the property is $740,000. If you list with me or Team Grande, you're probably going to get higher than that. If you list with someone else, you might get slightly lower. But let's go ahead and average that out. So let's consider that we sold it for $740,000. We've got our selling costs that we've got to factor in there. That's for your real estate and then some of the other disposition costs that you have. We got to factor in some legal fees to go ahead and close that. So the net balance after the sale is $702,040. Okay, so now you can start to see, I'm sure, as we go through this, kind of how these numbers are going to work out. So let's actually drive in, right? What are the profits that we're looking at? So remember, the net balance, 702,000. The mortgage is going to go ahead and get paid off. That's leaving us now cash remaining of $333,451. Okay. Remember, our initial investment was 119, right? So we've turned that 119 into 333,000, right? So our net profit, our profit before tax, on that investment, the original investment we've made about $213,000. So we've doubled it. Actually, better than doubled it when you consider the investment itself. Now, let's not forget about the tax man. So I want to talk a little bit about capital gains, right? So in Canada, when you sell an investment property for more than you bought it for, you owe the government some money for something that's called a capital gains tax. Okay? So the way the capital gain is calculated is you're going to take your selling price minus your expenses to go ahead and sell it. So that was that 702,000, right? And you're going to subtract your purchase price. That was the 550,000. That's giving us this. And again, this is just broad stroke things. I'm not an accountant. Your accountant would kind of help you work this out directly, but kind of broad stroke. We've got a capital gain here, approximately of $152,040. 50% of the capital gain is taxable, so that becomes taxable income. Okay, so 50% of that is the $76,000. If we assume a 25% nominal tax rate, again, very approximate number, see an accountant and everything else, going to qualify that out my nose. But we've got basically a tax payable on that gain of approximately $19,000. So once we give the government their piece, we're left with $314,000 in cash, and our return on our investment is $194,836. So the return on investment, for those who like percentages, you're into about 175% return. So very good numbers. Now, you can imagine, if you take this and you do good things with it, and I don't mean going out and buying a car. You maybe buy another property, you invest in other ways. You've really now started to build wealth that you can then snowball. Right? This is all, you start with a little snowball and you kind of build it up over time. And before you know, as the years go by, you're building up a lot of wealth for yourself. So just some other things I wanted you to know before we go away on this. One, obviously, this is based on 5 years. The longer you hold the property, generally the investment is going to look better, right? You're going to be paying down the mortgage further on an ongoing basis. You're probably going to start to be cash positive even at some point. You've got obviously more appreciation kind of through the years. You've got some opportunities to refinance the property and use it to seed other investments that you might have. Generally, I'm looking at 10, 15-year type investments myself. We did this based on 5, but obviously it's up to you and kind of how you want to approach that. I can't make any guarantees kind of on where prices go. We don't know what the future holds. What I do know is that the people who did this for the past 5 or 10 years actually had much better numbers even than these, right? So the investment's been very good. This is relatively conservative if you compare this to kind of what's been done historically. The other thing I want to make note is this is based on an investment property. If it's your personal residence, there's no capital gains, right? It's completely tax-free. You've also got options on your down payments, right? Maybe you can put down less than 20%. You get into homeowners insurance and things like that with those costs, but it means that your money to actually seed the purchase is lower. There's lots of incentives for first-time home buyers. Guys, if you want get into the market, don't save up to buy a car. Save up to buy your first house. I can't stress that enough. It will help you kind of long term. So those are the things you should know. I'm Albert, the real estate guy. Thank you. If you have any questions, if you're looking to buy or sell, don't settle. Go with a professional. They can help you the whole way through. You'll be better for it. My contact information is here. You know where to find me. Thank you, and peace out.